very pleased to welcome back to the show, Greg Weldon. So many things to talk to you about today, Greg. Appreciate you finding time. And I guess it's really hardly an in-depth question, but what are your quick blushes on talking about the economic and the financial side of a Trump presidency? I mean, certainly the markets have been cheering really since he was elected November 9th. Yeah, there's some inconsolidations, but the overall move has certainly been positive.
Well, yeah, it sure has. And I mean, we tweeted, in the overnight that when the Dow had hit a low down 700-800 points, it was down 300 or 400 when we tweeted, this is bullish for stocks. It's bullish for the energy shares. It's bullish for industrial metals. It's bullish for the bank stocks. And we've seen that move play out, precisely as we anticipated it would. The question here now changes, though. It's one of these things, kind of buy the rumor, sell the fact type of deal. You've gotten him in office now. Okay, now there's going to be demands that expectations that have built this rally be met. And that's going to be the big question mark going forward. So I think from here it is, you have expectations, you have reality. Where do they meet in the middle? How quickly can reality come towards expectations? And will the market be disappointed or not? So in my mind, it may be a time where you see some profit taking, congestion, consolidation, maybe a few dips, kind of seen it in some of the industrial metals. The rallies have kind of ceased. You've got some resistance up here in the equities. There's a lot of bearish technical divergences at these most recent highs. So I think it's a time for caution and a little more of a wait and see what is the reality of a Donald Trump presidency versus all the buffoonish rhetoric that we've gotten. Where are the policies going to fall? What can be implemented and how quickly? I'm happy you've just reminded us. I didn't talk about energy earlier. That's a positive impact for Canada if they go ahead with things like the Keystone XL pipeline. That would be the biggie from the Canadian perspective. But you're right. I mean, it's really interesting. He looks like he is prepared to really open up the energy industry in the U.S. through regulation, taxation, trying to get that energy independence. I mean, it's a sea change in that area. Yeah, and the shares have outperformed the underlying commodity, too, in terms of crude oil. I mean, TransCanada Pipeline is a great example. It's a new high yesterday. I mean, breaking out to the upside. Of course, you want to start talking energy, and we like some of the junior mining shares, too. We can talk about that going forward, and they had a good week. But everything in energy comes back to OPEC. It really does. So there, too, you have expectations versus reality. You have a reality where the market, particularly in the forward market, you look at 6 to 12 month, which, where the real expectation of if OPEC and Russia continue to play ball, you will see dramatic drawdowns in inventories to the point where maybe you can come into balance in the second half. And that would support prices. But does that support prices where the forward markets are now? Or, and what's the interim of what's the reality of OPEC, chronic cheaters, to the degree that they're able to keep their promises, let alone the wild cards of like a Libya or a Nigeria or a U.S. where the rig count all of a sudden is soaring. So from that perspective, again, it's just like the political Trump, industrial metal bank stock view is very much the entire energy sector is expectations versus reality, and can reality keep pace and eventually meet those expectations going forward?
I'm talking with Greg Weldon. You can find him at www.weldononline.com. Well, it's funny, Greg, I'm with you on the energy market. I think it's got ahead of itself. And one of the reasons, I think, is that, if there is some sort of real drawdown in terms of supply and the inventories come down, well, I just see, as you just alluded to, American production ramping up. As I say, especially if Mr. Trump is more positive, for Keystone. I know that would take a while to build, but I just see the atmosphere much better for North American companies because they didn't sign on to that OPEC deal. They're prepared to fill that gap.
Yeah, that's why we still like the shares better than the underlying commodity. That's why there are, a few select energy shares that look really good here. I mean, you look at the rig counts. I mean, just in terms of the rotary crude rig count, it's up, 30 in the most recent week. I mean, it's up 74% since the May low. Since the election, it's up 37.5%. So you've already seen that output come online. And what's interesting about the OPEC deal, too, is everyone looks at the supply side dynamics, is to look at the demand side dynamics. Because if OPEC can adhere to their deal, and we think the ability for U.S. companies to, increase their production is somewhat limited. It certainly, has a lot of upside, but it's not going to replace OPEC on its own. So if, OPEC adheres to its deal,
Then it goes to the demand side, too, where expectations, OPEC's at 1.1 million barrels a day increase in demand. I think the Dallas Fed has one of the better estimates, around 1.3. You listen to the speeches from the Dallas Fed, they fully expect that, even if OPEC is not 100% on board with this, if you get an 80% compliance, you'll be in balance by the second half of the year. You're going to watch the API and DOE numbers weekly now, because you need to start seeing the declines in inventories, because you have to whittle down that supply. But if demand meets expectations, and that looks like it's perhaps quite likely, if OPEC sticks to the deal, you could see very rapid and sizable declines in inventories, and that might get the market even more excited. So again, it's going to be really interesting, and to me, this is what gets us so excited to get up every morning and do this. I mean, is watching the weekly data, because it's the math will give you the tell that you need to figure it out.
Greg Weldon is my guest. I'll tell you this. I know, and I'm very privileged to know so many people in the analytical business, and I know this. Greg Weldon is the guy that other people read. Why? Because the depth of his research and a global approach to his research, whether I can throw anything at Greg, and I will when we come back. I'm going to throw gold at him for a second. I want to get his take, but we also I want to talk about Europe a bit and the U.S. dollar a bit, all of those things. Stay with us. You're listening to the Money Talks Network. Weldon is spelled W-E-L-D-O-N, online, weldononline.com. In case you're not familiar, Greg, of course, does this research, as I say, that's picked up by analysts and investors throughout the world, but also manages money. Two of the funds that he managed deal with precious metals, one precious metals and industrial metals program, and the other the precious metals. So I want to come right to gold with you, Greg. We saw that big bump after Brexit, big fall down, over the last while, I think including into November, and now we've seen a recovery. What do you make of it at this point? Has this just been a normal bounce off that sharp decline?
I think it's something more than that, Michael. I mean, if you go back, we were obviously bullish, very bullish. In fact, gold and silver, and particularly the equities, the beginning of last year, that worked out quite well. And then in the summer, we started getting more cautious, particularly into late July, early August, when we went neutral and we were looking for a correction down to 1250. We said you might dip below 1200. Well, we were wrong. I mean, you dipped a lot more than that. I think part of the reason, too, is you had one of the largest, you had the largest speculative position ever in both gold and silver from the CFTC Commitment of Trades report in the futures market. You had huge ownership of ETFs. From that perspective, right after the election, you had tremendous buying of gold. You remember that night was wild. Not only was the Dow down huge, but gold was up like $35. A tremendous flood of buying came in, and those longs got spanked. So the degree to which the decline turned out to be much deeper than we thought it was, it exceeded the 61% Fibonacci retracement of the entire rally from last year's lows, from actually 2015's lows. I still think the overall pattern, the overall thought process that it was a corrective move in what is a kind of a newer bull market still holds water for me. I think the dollar, maybe has seen some highs here. I mean, there are many currencies against which the dollar remains very, very strong, on a regular basis. But those currencies are becoming less and less. The list is shortening, not lengthening, versus really what we've seen since 2013. And there's many of the commodity currencies now that look quite good, from the Australian dollar right out to the Brazilian real, the Chilean peso, for example, the Colombian peso. There's kind of a host of them. The African rand, the CRB index, and the GIC don't look too bad here. And you have a macro situation where inflation is accelerating against interest rates that are still historically low, to where real rates are now at levels that might imply there's a recession or some kind of macro risk dynamic going on, when that's simply not the case. How does that play out? Well, it plays out by maybe interest rates going up, and you get a flood of money out of bonds and maybe into gold. Could an increase in rates hurt gold? It could. That's the downside risk. The downside risk is still that the Fed is ahead of the curve relative to other countries in raising rates, but we know the Fed is a little bit afraid to do that. Why? We got $20 trillion worth of debt that no one even ever talks about anymore. These are big issues when you're talking about the 5-year note and the 190 level and all of that debt, because the average maturity is 5.6 years and the average coupon yield's 1.9. So this is an issue.
I mean, I got to ask about the Canadian dollar also within that context. I mean, we saw a little bounce come up. Then our central bank jumps in this past week and says we could even drop rates. I mean, he didn't say that was the probable scenario, but a possible scenario. So we had that nice little run up, and then we dropped 1.6 cents. So where do you see the Canadian at this point?
Well, you did. You had the comments, and you had an outside-downside reversal week technically this week in the Canadian dollar. We want to like the Canadian dollar. We didn't like it. It really didn't break down. We kind of want to like it here. We think there are better plays out there. But we think, if you look at the employment numbers at the beginning of this month, Michael, I mean, they were really strong. You look at the trade numbers, exports have recovered very nicely. This week you got a little bit of a kind of a downer in the sense that retail sales were flat to down, although I saw many signs of strength within that report. And you also had CPI, which isn't busting out like many countries have their CPI breaking out. So that kind of kept that dovish thought process in play. I don't see it playing out that way. I think Canada goes with the Canadian currencies. I think Canadian inflation will rise and break out above this 1.5 level. And when it does, it's going to be very difficult for the Bank of Canada to be talking about cutting interest rates.
It's really interesting. We're at a place in this environment. When you get to extremes, usually all the news sort of points in one direction, but we're certainly not there. I can't think of any market off the top of my head in North America or the commodities, et cetera, where all the news is one-sided. I mean, and it's an interesting time for analysts to really pick which variables they think are going to dominate over the next short while.
Well, I think we've had a big shift in the, kind of the bigger picture mentality for me as an analyst, from where you're kind of looking at deflation is still the dominant trend to where maybe it's not the kind of inflation that people are used to, but the math right now is quite positive for inflation going forward. You've seen accelerations in so many places. I mean, take Germany. Germany's at 1.7 out of nowhere. Look at the UK numbers this week. They're big, and they also have wage gains there too. So this is a country where people have been thinking, hey, the BOE could still cut rates. No, I don't think so. I think the next move is tightening. I think that's going to be a shift in the focus away from, this QE and central banks easing and this perma money flooding the system to where, guess what? The math doesn't work anymore when you have inflation rates pushing towards or above your Federal Reserve and central bank targets, when interest rates in so many countries are still low, not only, nominally, but on a real basis, really low. So we're watching like the German 2-year note had a big push to the upside in yield this week. So these are the kind of things we're watching. And yeah, it's, the uncertainty is big because I think you're at a big turning point. And we tend to be early because we dig so deep into the data that we see it, and it takes some level of recognition on a broader scale, on a higher level. And I think we're headed towards that type of dynamic. So the first half of 2017 could be really interesting and could throw some curveballs to investors.
Greg Weldon is also going to be with me at the World Outlook Conference, and I'm only asking 2 questions to the super panel, of which Greg is going to kindly be with us. And I'm going to ask him what the biggest surprise coming in 2017 are, what's their biggest money-making idea for the year. And what's interesting, Greg, is things could change between now and then. I mean, that's how fast it seems that some things are moving, especially when you get a new president and a whole bunch of uncertainty surrounding the policies he's going to enact.
That's a great point, Michael. It really is, because, I think that of all the things going on, that might be the most astute point, because it really is very difficult to have a long-term view on anything right now. Like, the buy and hold investment mentality, may not be dead, but in my mind, it's dead. It just doesn't know it yet, because it's extremely difficult to have a long-term view, stick with conviction, and go through some of the swings and maybe not even fully, see some of the twists and turns coming. But again, that's why we love to get up every morning and dig into the data, because ultimately the data tells the story. And right now, from that perspective, again, we have several positions that we like, and we're looking potentially at, again, being short the bond markets here, because this rise in inflation against the low level of nominal rates versus the overhang of debt is problematic to me for bond markets. So that to me might be my right now. We'll see in February whether this holds through. But I think bond markets are at risk. We're looking at the UK as potentially one of the first victims.
And a really important point to make, because we're talking about a major shift. We've had this thing going on since 1980, 81. That is what we talk about, a mega trend shift, and that's why you can tell I'm thrilled to have Greg Weldon with us today, but I'm really looking forward to chatting when we come to the World Outlook Conference. And as usual, Greg, just many, many big thanks for finding time for us here.
My pleasure, Michael. You guys do a great job, and I'm always happy to contribute.